Hey everyone, it's Nicholas Merton here from Data Dash, and we've got to spend some time to talk about the story that's gotten everyone riled up in traditional finance, and that is no other than the story tied to the company GameStop or the stock symbol GME. Now, I'm not only going to spend some time to briefly explain and kind of walk through the steps of what's been going on with GameStop stock, what led towards its meteoric rise, and also its current downfall, and outside of that as well, spend some time to talk about what this means for finance as a whole, because what's going on right now is really unprecedented. It is a historical moment when it comes to finance, and it's going to leave us with a lot of questions that probably lead towards an answer around the cryptocurrency and decentralized finance space. So let's go ahead and dive straight into it, guys. This right here is the stock chart for GameStop. Each of these candles here represent a day's worth of price action, and as we can see here, from roughly around the start of the month, turning into the new year here on January 1st, we were at a price range of around $20 here per share, a little bit below $20. And we saw a meteoric rise of GameStop, an old brick and mortar retail store, going all the way up to a peak of around $480 earlier today. Now, a lot of people are curious as to what causes these kind of surges, and along with that as well, why something like this can happen in the market, especially when it's so skewed from the fundamentals. And it has to do with something known as a short squeeze. So let's take a step back here. Over the last couple of years here, if we take a look back in time here on the weekly chart, we can see that GameStop shares here had been trending down for a long period of time. And it makes sense on a fundamental basis. Brick and mortar retail stores like GameStop, which used to be the pinnacle where people would get video games back in the day, have now become relics of the past. They have started to take on massive negative earnings. Their fundamentals have been broken. And because of that, there have been a lot of wealthy investors, predominantly hedge funds, famously like Melvin Capital in this case, who were taking substantially high, overwhelming bets against the company through what's known as short selling. They were basically betting on the price going down over time. Now, a lot of people think that short selling is just like longing a stock. There's somehow some magical way where you can just bet against the stock. And when it comes to traditional short selling, that's not the case. There's an actual methodology to how short selling is done, so you can benefit from the downward move of a stock price by betting against it. So how does this actually work? Well, it works very simply. A lot of people get confused by short selling, but how it generally works is that a individual, in this case, using a brokerage platform, in this case, like E-Trade, would probably go out and, in this case, borrow shares from another user in this case. Again, it's all abstracted and obfuscated in the background. Borrow a certain number of shares off the market with a certain amount of capital that you have, and basically immediately sells those shares on the open market into a cash position. And the general goal here is that you're hoping overall, and we can just go here, for example, to GameStop. Let's say I open up a short position here at $6 per share on April 29th of 2020. I'm hoping in this case that the share price over the next following days is going to go down, and I'll be able to probably close my short position at a lower price. So what I'm generally doing here is I'm taking my newly founded loan, in this case of shares of GameStop, I'm instantly selling them. And what I'm doing is waiting for that lower price where I can buy them back with some of the cash allocation, return the shares with some rate of interest owed to the brokerage platform or bank that I borrowed it from, and I get to keep the cash. I get to keep the additional profit that I made on betting on the shares going down, because I only have to spend $4 per share versus $6 per share now. That's generally how short selling works. And if you can be on the right end of the trade, it can be very profitable. You can make up to 99.99% in this case. Not as much as when you go long on a stock or you buy shares, because that can go up infinitely high. There's no limit to where a share price can go, but you can bet all the way down to $0.00 per share. So generally speaking, almost nearly 100% return if you get your cards right and the company were to go bankrupt. Well, because of this, there were a lot of companies who built too hefty of a position on their shorts. And over the last couple of weeks, there has been this trend here on a subreddit known as WallStreetBets. This has been around for a long time. I've lurked it from time to time. It's basically a community of traders and investors who definitely take kind of a you only live once or YOLO approach to investing and take a lot of excessive risk. Well, they all rallied around buying a single company in this case, and that was GameStop. A lot of people, so much in fact that famous retail trading platforms for stocks like Robinhood, which we're going to talk about later on, had over 50% of its users buying GameStop shares. And this led to not only a meteoric rise in the price here, breaking away, of course, probably from the fundamental valuation of GameStop shares, But along with this, it led to what's known as a short squeeze. And that's what explains this here. So what is a short squeeze? Well, all those shorts who are borrowing shares in this case to bet against the price of the stock and immediately selling them on the market in a cash position need to cover for their shorts, right? When price gets too high, in this case, they can start to take a very high impact loss. So in order to cover for short positions, what they have to do is the counter opposite. They have to take the cash that they have and buy up available shares on the market, returning it back, closing out their official short position. This effectively causes additional buy-side pressure, more upward movement in price, and because of this, caused a rapid short squeeze, the likes of which we have never seen before in history, turning what was originally looking to be almost nearly a penny stock, in this case when it came to GameStop, a microcap in valuation, into a multi-billion-dollar company yet again. So this is the whole story of what happened here, guys. And now that we understand this here, I want to go ahead and dive a little bit into what's happened. Why is it that we're now seeing GameStop shares start to falter over? Is the trend dead? Did people want to just start selling in this case? Well, no, that's actually not what happened here. What happened here is that we're in a traditional sense like this where there may be some wrongdoing. I have no doubt about it, guys. There's probably some people who have coordinated this, and this could be very much on line with breaking the CFTC's regulations against pump and dumps, against all the major protections that we have in order to basically prevent market manipulation. I have no doubt that there's some possible wrongdoing here. And in a normal case scenario, if there is wrongdoing, you would have regulated authorities like the SEC, or you would have the actual exchanges in this case, like the New York Stock Exchange, the CBOE, the trading authority in this case, who's running the order book. They would be the one preventing people from trading these shares. But they're not. In fact, another set of parties have decided to prevent people, and they're the exact same parties that allowed people to buy up and ramp up the stock price in the first place and make rampant speculant bets, whether it's in options contracts that are even more volatile than just buying shares alone. And that's basically brokerage platforms like Robinhood or a variety of other broker dealers in this case that allow you to go long, go short, buy options contracts, buy puts and calls. They basically decided to allow for the buildup of a bubble, and then they decided that they're going to pop it. So right now, there is basically, just to summarize this, you've probably maybe even seen the headlines here that Robinhood customers are now suing the app in this case for this decision. And basically what they did is they prevented users from being able to further buy GameStop shares. They haven't halted trading on the app. No. They allow you to sell the shares in this case. That's all you can do. You can sell your position. You can no longer buy it though. Now tell me for a moment if that makes sense in this case, if that's something that a brokerage platform should be able to do. A company that has willfully allowed people, bear in mind in this case, if they're supposedly looking out for the end user, allowed users to lose tons of money, in this case taking excessive risk on buying random shares that could have steered from fundamentals, trading options contracts that can make you lose your money in an instant. I don't really think so. And I don't think it's Robinhood's jurisdiction, especially when there's a good, able-bodied set of regulators and reputable exchanges that have been around for a long period of time to deal with these cases. I don't think it's Robinhood's job to do so. And you can see here that across the board here, if you just scroll down Twitter right now, I mean, this is my general feed here. I'm not even filtering for Robinhood. Most things now are talking about Robinhood overall and this general story that's going on. But here's the thing overall, guys. On a principle basis, everyone is realizing that this is wrong. You talk about politics, for example. You've got Ted Cruz, who's on generally more of the conservative end, and AOC in this case is more on the left when it comes to American politics, both fully agreeing here that this is wrong, restricting people's right to be able to buy and sell assets when they so choose to. You know, that's the simple job of a brokerage platform. A brokerage platform is aimed to do one thing. It's allowing you to be able to buy or sell an asset or trade other financial instruments as you choose. You have a right to be able to trade these assets. It is your money, in this case you're trading, and then when you convert it to these assets, it is your right to own these different types of assets. And Robinhood as a platform was able, in this case, to be able to provide that opportunity. And now they've decided that they're going to be the market makers, that they are going to prevent you from being able to buy more of those shares at that price, to take that opportunity. Effectively, in this case, leaving everyone who's bought GameStop shares in this case now probably down, or at least in the last 24 or 48 hours, down in the red, with no other opportunity than to simply sell their shares and probably take on some form of a loss. This is wrong on so many levels. And the reason why is it's a principle basis, guys. We have seen for the last few years, when it comes to things like the 2008 financial crisis, when it comes to what's happened here since back in March, when we had the pandemic, in this case, the market crash, the sheer amount of defense from central banks, from corporate clients in this case, from regulators, to always suffice and take care of these massive hedge funds and these massive entities in the financial world. But when it comes to the retail trader in this case, the everyday person, your average Joe, there's no such level of protection, no such level of care in this case to allow people to be able to do what they want. And again, bearing in mind here, if we take a look over the past here, going back to the, for example, JP Morgan, this was a great story here. JP Morgan got caught with basically manipulating for nearly a decade the price of silver in this case. And no one actually went to jail in this case for spoofing for an entire decade, suppressing the price of a commodity, one of the largest commodities that's traded in the world, suppressing that price for over a decade. Just pay a fine in this case. No one goes to jail. How about, for example, the financial crisis in 2008? Not a single person. There was actually one person in this case, one person, out of the hundreds of people who were responsible for the financial crisis who went to jail. Outside of that, it was a few handshakes, a few penalties here and there, a few new regulatory checks, and business as usual. And a ton of QE money from central banks. So, look, we've really got to have a discussion here, guys. Is this going to be the standard for finance in the future? Are we going to accept this as the means to where we trade assets? Because what this tells me overall is that this shows me that a lot of the concerns we had in the cryptocurrency space about censorship in this case, right? Not just censorship of speech, but censorship as well of your ability to send and receive transactions as you would with, say, cash or traditional payment means. And along with that as well, right? This was what we were concerned about for the last decade in crypto, about payments and being able to not have your account frozen. What we've got to ask now is whether or not brokerage platforms are going to allow us to buy and sell as intended. The single service that they're supposed to provide in this case to us as users who are putting our trust, our funds, our livelihood for so many people on these platforms. Well, I can tell you all something. There is a solution to this. It is decentralized finance. There is nothing else here to look forward to, guys. I think you're going to see more and more of this problem escalate. I have no doubt there might be a bit of a cool down, but I have no doubt that this is not going to be the last time we see these types of GameStop events, these rampant pieces of speculation in the market. And to be honest with you all, there's protocols like Uniswap in this case that do tons of volume here, and they allow you to do pretty much the equivalent of a market order like you would usually do through Robinhood into any cryptocurrency that you like without any permission. You're just able to do it. You're able to buy and sell whenever you want. It's never down like Robinhood and so many brokerage apps. It never shuts off. And along with that as well, it allows you to trade. You know the terms of it. You know the fees. And that's why at Digifox, we plug in directly to Uniswap here. We've gotten a lot of people excited around this statement that we put out. And it's so true. We can't halt your trades in this case. And we wouldn't want to. Because with cryptocurrencies, you have that sole opportunity to be your own bank. You have that opportunity to expose yourself to the assets and therefore the potential reward, but also the risk. It's not Digifox's job, and it certainly as hell isn't Robinhood's job to tell you that. Now, I do believe at the end of the day, I'm someone here that actually gets a little bit of crap for this. I do think that there is a wonderful spot for regulators to play a role in all of this. There are great regulatory checks and balances. I've had chats with members of the SEC before. Like, for example, we've got the mother of crypto in this case. She's been, for example, overall a really big proponent of deregulating and keeping in mind low regulatory checks for crypto. I've actually argued in favor of things to prevent things like we talked about with the JP Morgan story, of things like spoofing, of fake volume. There are things that need to be balanced and kept in check. But it certainly as hell isn't the ability of someone to buy and sell a given stock. And it certainly isn't Robinhood's job to be able to deem that. And I think today, after someone like myself, and again, I'm not just bashing Robinhood here because I have some interest in bashing Robinhood. I used Robinhood for so many years, and it is absolutely painstaking to see that they've not only made this decision, but that they're standing their ground in this case for whatever possible personal or financial reasons that they might have. I really am a bit speechless, guys. I mean, this is a big moment for finance as a whole, and it speaks to why we need censorship resistance. We need to give you the ability to have control of your financial activities. And from the outside, in this case, we can still have great checks from regulators. We can still have a smooth, functioning financial system. But there is going to be speculation in markets. We've seen this for decades. And I can tell you, GameStop, if they think that by censoring trading on GameStop is going to stop this kind of movement and not just bring more traction to this kind of rampant speculation on the retail trading side, I think they got another thing coming to them. So anyways, guys, sorry for my ranting and raving here. If you like this video, consider dropping a like. If you agree or disagree, let me know down below in the comments. I think that this is a serious conversation we need to have. And like I mentioned, I think that this is going to call on a lot of legislative discussions about how we go forward in treating these things. Can a brokerage platform do this to its clients? Because it's not as simple as saying, oh, you can always move to another platform when you're sitting in shares, in this case, that you've invested in. Because you either have to sell it at that point, or you have to, along with that as well, move your funds off the platform. I've heard too many excuses here. This is not a proper way to deal with this situation. And I hope more than anything that we'll start to see some positive changes here, so we don't have to always resort towards a financial future that's completely decentralized. But they're building their own grave and they're setting the stage for it. Anyways, guys, that's it for today's video. Thank you all for listening to me ramble as always, and I'll see you all in the next one. Take care, everyone.